Hello, this is Jordan, and this video is being recorded on Wednesday, January 12th, 2022. Thank you so much for joining me. Please like, comment, and subscribe if you're watching this on YouTube. I'll have a lot more content coming this year. And in this video, I'm going to discuss gold's 8-year cycle and why cycles in markets are not actionable. And, if you follow my work, you know that I'm not a fan of cycles analysis. But I always say, if you're following someone who helps you make money, that's really what the most important thing is. So if you're following someone who does cycles analysis or you're following cycles yourself and that's helping you make money, then I would stick with that. I'm not trying to tell you to not follow someone and follow me. I'm just giving my opinion on some particular cycles and why I'm not a fan of cycles analysis. Now, I'm going to go through some popular cycles of the past. And first, this was a real big one, which was really popular, and you never hear about it anymore because it completely stopped working. This is the 4-year cycle low in stocks. And when I really started getting involved in the markets in the early 2000s, I remember this. After 2002, I remember people talking about it in the mid-2000s, coming out of the tech bust and that bear market, and that was a big deal. And that 2006, we'd get some kind of cycle low around that time. And you can see I put the question marks there in 2006, 2010, 2014. So it just completely stopped working. But this was a cycle that until that time, it appeared to be working really well. That nearly, every 4 years there was some kind of a low in the stock market. I mean, you have 2002, which is a significant low. 98 at the time was a significant low. 94, that's before the market really took off. You have the recession in 1990, and then one time it didn't really work, which was 86. You didn't really have one. 1982, obviously a major low. 78, stock market corrected 20%. Mini bear market, you could say. 74, major low. 1970, major low. 66, that was an important low. 62, I mean, the market was red hot, but that was a significant low. So this was something that was working really, really well. And then suddenly it just stopped working in the mid-2000s. So that's why you have to be careful about these things. In another example of a very popular cycle, which I think is more significant and more, I would pay more attention to this based on intermarket analysis, and that's stocks versus commodities, because we know that markets go through secular periods where stocks outperform, they have a bull market. Then when stocks have a secular bear market, that's when commodities have a secular bull market and they outperform. Now, it didn't really, you get to the mid to late 60s, some commodities, some metals were doing pretty well. They were rising. Stock market was obviously rising. So in the 60s, that was one example where the two were kind of trending together for more than just like a couple years. But anyway, this is a chart from Barry Bannister, who's one of my favorite strategists, and this was published in 2002, projecting a commodity bull market. And so what he and his associates found is that this cycle between stocks and commodities, it averaged 18 years. So it wasn't always 18 years, but it averaged 18 years. And this is something that worked really well from 1930 to 2000. Okay, you have commodities. I put my annotations on the chart there. From 33 to 51, that was a commodity bull market. Now, the way the cycle looks at it, I think it was 1930 to 1947 or 49, something like that. And then you had the 1949 to the mid 60s was super bullish for the stock market. Commodities kind of had a mild bear market until the 60s. But anyway, and then you look at the CRB commodities. I mean, mid to late 60s to 1982, that was a bull market in hard assets. And then, of course, stocks made a major, major secular low in 1982. Then had a great move until 2000. What happened? Well, we had a commodity bull market, as we know, from, you can measure it from 99 to 2011 or 2001 to 2011. In real terms, I think it was 2000 to 2011. But what happened was that 7 or 18 year average cycle, and there's another cycle I'm going to show you in the next chart, which is 17 and a half years basically. But that average, that cycle, it really stopped working because that cycle was telling you that the bear market in stocks really should have, the secular bear market really should have continued until 2017 or 2018 or something close to that point. So the outperformance between commodities and stocks, it was really short-lived, that particular cycle until 2011. So based on these historical cycles, that really should have lasted longer. And shout out to Kerry Ballantyne, I think is his name. I don't know if I'm pronouncing that right, but he came up with the 17.6 year cycle, and I put his Twitter there at the top. And one problem with cycles analysis is the people behind that analysis. They're devoted to their cycles like religiously, and so Kerry is still emphatic that this 17-year cycle, it really began in 2018 and that it's going to continue for 2035. But the problem with that is there was no other asset class that was outperforming from 2011 to 2018 in that 17 and a half year space. And also in 2013, the stock market had this massive breakout. So we see this where some people are saying that the stock bull market didn't begin until 2013. This cycle, based on the cycle, he has to tell you that, it really started in 2017 or 2018. And he makes the argument, well, from 2000 to 2018, there was performance wasn't that great for stocks. And, I guess that's fair. But again, if you go back and you look, that argument doesn't make sense to me because commodity bull market ended in 2011. Stocks broke out in 2013. If you want to use a point when it really shifted and you say it wasn't 2009, it was 2013 or 2018, for me it was really 2011. And so there's just and that's the problem with cycles analysis is these guys are trying to, they follow the cycle and not the market. They're trying to map, the cycle is the crystal ball or the holy grail, and they're trying to map the market to the cycle when it's really the other way around. You just have to read the market because the market is the ultimate arbiter. Cycles are subjective. They're not really actionable in my opinion. And so I'm going to show you the problems with gold's 8-year cycle. And, here I have the red is those are the 8-year cycle tops. The blue are the bottoms. And, sometimes between the two, it's like 7 years. Sometimes it's 8.5 or 7.5 years. And so that's, one issue with this is that the cycle low comes 7 years later. They'll say, oh, well, it just came 1 year too early. If it goes, if it takes 8.5 or 9 years, they'll say, oh, it was just 1 year too late. So this stuff is not really predictive or actionable when you're looking at the next couple years. And, the biggest problem for gold's 8-year cycle, it wasn't viable in gold's secular bull market. So if you think gold is going to go into a massive secular bull market, or you're a gold bull, you really should pay little attention to the 8-year cycle. If you look at the secular bull market in gold, 2001 to 2011, so the 8-year cycle top was supposed to be in 2004. And yes, mining stocks had a bullish consolidation for 17 months during that period. But if you look at gold, it made a peak in 2004, and then it made a higher high. It corrected for a couple months. It made a higher high 4, 5, 6 months later. So you can see that, compare and contrast that 8-year cycle peak to all the other ones when gold wasn't in a secular bull market. So the cycle is more significant when gold is not in a secular bull market, one could conclude. Go back to the 1970s. The peaks, you had a peak in the very end of 1974. You had a peak in 1980. So the two major peaks there were not 8 years apart. So it's, the peak would have to be 1972. So it wasn't viable. So the cycle is not viable when you're in a real bull market for gold. And, the last thing is I'm just showing some potential scenarios here for gold. And obviously, I could change when I get new data, I could change my opinion. This is, and me just guessing here, this is not actionable. I'm just thinking, oh, maybe this could happen. But I'm showing you some potential scenarios that are different based on, when gold could break out of the super bullish cup and handle pattern. It could happen sooner than I think, before the median scenario at the top. There's also a worst case scenario where, let's say the Fed, they're able to hike for 2 years and inflation comes down and, growth really doesn't become a problem until, let's say, the end of 23 or 24. The blue, based on the 8-year cycle, the blue arrow, that shows you where the 8-year cycle low would be. So the 8-year cycle low is supposed to come in 2024. I am showing you here different outcomes for the market and where the 8-year cycle low could occur. And I just sketched these out. I wasn't even looking at the time or thinking that there's a cycle low. And you can see in the super bullish case, let's say gold takes off and it has a really good run for 2 years into 2024, and then it corrects for a year into 25. The 8-year cycle guys will just say, oh, well, the cycle is 1 year. It came 1 year too late, but it's still in effect. Now, in the worst case scenario, where let's say we have this move after the rate hike where gold has a good rebound, but then it consolidates for, another 12, 15, 18 months. And then the next significant low is at the end of 23 or early 24. Boom. Then that scenario, that's your 8-year cycle low right there. And then the top scenario, a median scenario, like let's say gold makes its big breakout move in about 18 months, sometime in 2023. Well, you could just say, well, the 8-year cycle, it was 7.5 years or it was 7 years. That's really what happened. So you can see that based on all these scenarios, the 8-year cycle isn't really telling you anything about, where gold might go or when the next, significant low might be. It could be perfectly in 24. It could be a year before. It could be a year after, so the cycle could fit all these scenarios. But it's really not, it's not actionable. It's really subjective. I mean, it's more of a coincidence in my opinion. So these are just my, my thoughts on cycles analysis and why I'm not a fan and why I don't think they have a lot of predictive value. But, with that said, if cycles analysis is helping you make money, that's all that matters. If that's helping you make money and I'm not helping you make money, follow the cycles analysis. It comes down to what helps you make money. I'm just sharing my opinions on why you should not worry about the 8-year cycle low and it's telling you that gold has to go down. I mean, it doesn't. It's going to depend on the macro and all of that, and not what a cycle says. So that's all today. I hope you like this video. Let me know what you think, and I'll do another update for you guys in the days and weeks ahead.